All right, everyone. Welcome to another Altos Trading Live Strategy Session. This is Richard Van Rich here with Jeff Tompkins and Craig Ward in the chat. Wow, we're really excited to have you guys with us tonight. Got a lot of good stuff to go over. It's going to be a long session today. And just your first time on one of the sessions, you'll realize your microphone is muted. That's so we can all hear Jeff and I talk. But there is a Q&A box. If you have any questions at all throughout the evening, put them in the Q&A box and we'll get to them throughout the night. If you have to hop off for any reason, this is being recorded and will be available in the members area and also on YouTube by tomorrow. So before I bring on Jeff, let me read the disclaimer. Trading in securities and options involves risk. Part of buying and selling an option, investor must receive copy of characteristics and risk of standardized option. Investors need a broker trade securities and options must meet suitability requirements. Past results are not necessarily indicative of future performance. The performance figures are based on actual trades, including real money results. Due to the time-critical nature of trading, broker fees, and activity of other subscribers, there's no guarantee the subscribers will mirror our performance. The performance numbers shown are based on trades users could enter based on the trade signal. So if you have any other questions about your account, subscriptions, access to trade, anything like that, email support@altostrading.com and we'll get to you tomorrow with all that good stuff. So let me hand it over to Jeff. Jeff, you want to grab the screen?
Hello, guys.
There you are, back from the dead.
Yeah, I got hit by COVID.
You are double immunity now, right? You got to be like superhero status.
I got my natural booster last week.
I've just been drinking Coronas since 2020.
Yeah, that'll kill it.
Yeah.
Anyway, yeah, good to be back. Sorry we had to postpone last week, guys. A little under the weather, but good to be back among the living here. So we'll make up for it tonight.
That's right. Just have your tea ready for you.
Yeah, exactly. Hopefully my voice doesn't give out on me. All right. Yeah. So tonight we're going to cover, let's see, I guess we can go ahead and flip our videos off. You want to get mine, Richard, and we don't block the screen for anybody.
Let's see.
I can get mine here. There we go.
All right, there we go.
All right. So yeah, tonight, guys, lots of good stuff. As usual, we'll start out with our market recap and analysis. We focused in our last, probably 2 or 3 live sessions on the Slingshot rebound, and we'll talk about how that's played out. We're going to focus on a specific strategy on our session today: option calendar spreads. I think this is a good strategy. It's in line with current market conditions, and I'll show you guys, if you haven't traded calendar spreads or aren't familiar with them, we'll cover what they are and how you can use them. And I promised last time, since we ran out of time for you guys to share any symbols you wanted to review, that we'd spend a lot of time on that tonight. So get your favorite stock or ETF or whatever you guys like to trade ready, and we'll review those. And if it's optionable, we will look at how to set up a calendar spread on that. And then we'll wrap up with our Q&A as usual. So let me go ahead and get over to our platform. I'm going to run a quick refresh. Let's see it. Looks like we actually got our refresh data. Let me just make sure everything's updated here.
Sweet.
For some reason, it's like it's delayed. Let me refresh one more time. All right. Looks like it hasn't done the full update yet, so I'm actually going to go ahead and switch over to TOS here. Okay, so let's start out taking a look at the S&P. So we talked about the Slingshot, and this is picture perfect on the S&P, where we're using volatility bands, specifically the Bollinger Bands, as support and resistance, so dynamic support and resistance. And what we're looking for is a volatility expansion to the downside. So that would be in the case of the sell-off we saw in January. And then we're looking for that sell to find some support And we also looked at this in the context of the VIX. So we'll use that as a tool and a gauge to help us time the end of the sell-off and help us accurately identify when it's over and it's going to rebound. And then that's one way in combination with trade trend to time these bottoms on these volatility expansions or sell-offs before the market rebounds. And then we talked about how the market will rebound at a minimum to where the volatility expansion initiated, and that would be where price started to follow the lower band. And this is like a picture perfect slingshot here, where the volatility expansion started on January 18th. As you can see here, let me actually get my drawing tool out here so we can annotate this. This is the volatility expansion, okay, on the 18th. Here's the sell-off. And you can see we had a lot of indication that price was bottoming because we get these long wicks at a level of support. And why is this a level of support? Well, if we look back to September of last year, and we draw a horizontal support line there, we see that there was a major level of support. Because what happened here, there was also a sell-off in September of last year that bottomed right around the 4250 to 4300 zone. And then we got this huge pop to the upside. So that was a previous demand point. There was demand in the market for buyers to come in and drive prices back up. And so that's what was happening here. We get these long wicks rejecting that previous level from September of last year. And then we get the rebound. And I should also point out there was a buy warning here from Trade Trend. It took a couple days, or it took a few days to trigger. It didn't trigger on day 1, day 2, but it hit the entry price on day 3 following the pending signal here. And then we get the rebound up into that level. And we called that. If you guys have attended or watched the recordings of our last couple live sessions, I called this right here, right? So if you were wondering, where's this thing going to bottom out and turn around, and if it does turn around, where's it going to go back to? We called that ahead of time, and that's one way. And also using the VIX. So we're going to take a look at the VIX here too. But you can see the reliability of this type of setup in rebounds. Now, one thing to take note of here, oftentimes when we get these slingshots, we will surpass that level of the volatility expansion. So that's going to be kind of right around 45.75 here. And in this case, we saw it top out, and then we saw a bit of a retracement here over the last four trading days. So what we want to look for in terms of, so this is now a resistance area. So price is going to resist that level until if we break through it, that story will change. So until we break through, this is now a resistance zone. But if we do break through and specifically close above that 45, well, it would really be the high from this candle on February 2nd, which was 45.44. So if we can close above, let's call it 45.50, then what we expect to see from there is a parabolic move up into the 4,700 to 4,750 level. If we can't break through that, there's a couple likely possibilities that we typically see, and I'm going to clear these out to emphasize that and zoom in a little bit. We'll often see a W pattern or a double bottom. So what that looks like is, here's the sell-off, the rebound, can't push through, we come back down. Then typically we'll see a retest of this high from February 2nd. And if that resistance level holds, we'll see price come back down and double bottom at these previous lows. and that forms a W. And then generally what we'll see is another rebound off that level back up if that pattern ends up playing out. The other possibility is, again, as I mentioned, we break this resistance level. And if that happens, that's very bullish. And we typically get a strong parabolic move. So I'll show you an example of that. We looked at that last week, or sorry, 2 weeks ago. But here was a slingshot here. There's actually a double slingshot, a mini one there. See, it came back up, retested, came down. So this is actually a little bit of that W pattern I was just pointing out. So you see we've got W, double bottom. Then we came up and closed above the middle of the slingshot there. And that happened right here on this candle. So around mid-October. When you see that happen, now this did happen at the upper volatility band. So if that occurs, I like to wait for another candle or two to make sure it's actually going to follow through. But you can see here in this case it did. And then you get this major volatility, or sorry, major parabolic move. So that's very common for this slingshot setup. So there's a lot of good opportunity in the market right now. The last 4 days have been a bit tricky, and it's not unusual. We get this kind of chop where we just get a down day, an up day, a down day, an up day. So this is going to be a key week, and it's an earnings week. We have a lot of earnings coming out. There's a lot of news in the pipeline that's going to drive the market and cause more volatility and more extreme intraday moves. But this will be a good week to see which direction this thing goes based on what I just showed you. Is it going to go back up and break through and go parabolic, or is it going to form that W and come down double bottom? Either way, it's going to create two potentially great opportunities for us. So we want to be prepared for both, whatever happens. If it comes down here, that's a good buying opportunity. That's where I'm going to look to come in and buy down at around this 4250 to 4300 level. I would be, for me, that I'm a big buyer down at that level, or I'm a big buyer on a break above this February 2nd candle. And I wait for a close above the high of this day, not, and that, again, that's 45, what did we say? The high here was 45.90. I think I misspoke on the high a minute ago. It's actually 45.95. So that's so close to that 4,600 century mark. I want to see it close above 4,600. And then I would look at, getting more aggressive on the long side from that breakout. Because it's pretty unusual to have a false breakout on that type of pattern. Or if we double bottom, I'm an aggressive buyer down here at 4250 to 4300. Keith, the volatility bands. So the settings are just the defaults on the Bollinger Band. So the standard deviation setting is 2. Okay, so 2 on each side, because this is going to be your upper and lower bands. And then a 20 period setting for the middle band. All right, so now let's take a look at the VIX and how that also was a great gauge of identifying when this turnaround and when the sell-off was going to stop and the turnaround was going to ensue. So we had this really strong bottom, and a lot of times when you see consolidation like this, at a support level, it tells us that that price is bottoming and potentially moving back up. And that's what I'm seeing right here at the moment. Before we jump over to the VIX chart, is the consolidation over the last 4 days is near a support level. And that's this one here from back in late November. And then it was a resistance from back in late September. So, yeah, it's kind of like one day to the next year, but with a lot of whipsawing. So that's why we want to watch these support and resistance zones for how price reacts around those. But you see how this right here over the last 4 days, this price action looks very similar, but just less severe, lower volatility. And that's because of the VIX, as we'll look at in a second, to this consolidation right here from late January. It's a very similar picture here between these two periods. And after this consolidation, we moved up. So if we move up here, just look for that resistance at 4,600. I don't want to trade into the 4,600 level because that could be resistance. I want to wait for a close above 4,600 to become a buyer and go long. Or I want to watch and see if those resistance levels hold or this support level right here breaks and then moves back down. All right, so this all occurred, this consolidation occurred late January, right? So everybody's wondering, we're in this big sell-off, S&P is way down. Nasdaq almost went into bear territory. I think it troughed at like 18%, down 18%. So how do we know, when is this thing going to lose steam and start to go back up, as it inevitably does? Ed, I'll tell you the exit for the Slingshot. Yeah, it's the point of return to the band break, exactly. So when you get in, and again, we're looking at that right now. Right now, we're kind of focusing on the entry on the sell-off. Here is the trade trend by pending warning. But the first profit target is at the level where the sell-off started to trail the lower volatility band. And that was, of course, was reached here on February 2nd. That would be my first profit target level. Generally, if I'm going to scale out of a position, I'll take profits on half the position at that level, and then move my stop to break even on the other half of the position, which would be on the trade trend signal right here. You're using the trailing stop, it actually would have been taken out. So that would have been a nice trade there on half, and then a break even on the second half of the position. And then as I mentioned, if we break above or close above the high from February 2nd, then then you're looking at the upper band for a profit target of your second half of the position. So those are the target levels on the Slingshot. So yeah, let's look at the VIX. Okay. And see how, and same exercise on the VIX, guys. So make sure, you map out your levels here. But why am I bullish right now, short term? Because the VIX is retreating back down into the 20 level. But you can see, let's see here. We've got a lot of resistance around the 24 level. Like right now, I'm short 24 calls on the VIX. Actually, they expired today, so expired in my favor. Did nicely on those. But what happened towards the end of January that told me that sell-off was probably over? In hindsight, it was definitely over for the time being. Is look what happened on the VIX. We get this spike and then a retreat, and then we start printing red bearish candles. All right, so this actually gave me forewarning that the market was bottoming. When I look at that in the context of the fact that the S&P also hit a support level that we looked at a minute ago and was coming back down. and it was breaking through these support levels. Okay, the next one's 20 from here. So we closed today at 2144 on the VIX. The next one's 20. If we break through 20, then that scenario that I pointed out to you on the S&P, where if we closed above 4,600, which was near the high of February 2nd, that will likely see the market go parabolic and rebound. So that's why it's so important to look at the S&P in the context of the VIX, because remember, the VIX measures it's truly probably the only forward-looking indicator that it's not using any lagging information. It's actually measuring the expected volatility of S&P 500 options over the next 30 days that can tell us ahead of time what the market's doing. Very few people out there, guys, use the VIX like that, as a gauge for what the S&P is likely to do over the next 30 days. If they did, there'd probably be a lot more successful traders out there, but not a lot of people know about how to use that. So I'm glad you guys are on and learning this, because you'll see as you get more proficient with it, how much of a difference it can make for you in timing different events in the market and just knowing what's going on in the market. And conversely, when we're in an uptrend, if you see the VIX go from below 20 to above, and or you get a buy warning, green arrow there from trade trend, that's your warning that start being cautious. Even if the market's in a strong uptrend, there's a really good chance we're going to see a sell-off. We don't necessarily know what the severity of the sell-off is going to be, but we at least have a very good warning that the market will likely sell off. Okay, and we see those all over. So we want to look for that below 20. We want to see the VIX rise above, specifically close above 20. So it actually didn't happen until right here, mid-January. That was our warning on, what day was this? January 13th. Watch out, because we went from closing below 20 for several weeks to closing above, and then we see the VIX start to take off as the sell-off ensues in January. So now we're just doing the opposite. We're looking for the VIX to spike and start rejecting higher resistance levels. Here's another one. And then closing back below that resistance level. That was our clue that the sell-off's over. And again, in the context of the S&P hitting a support level and also getting a buy signal from trade trend on the S&P, that was our clue that the sell-off was over. It's now, in my opinion, safe to jump back in as a buyer and ride the wave back up to the volatility breakout. So that's how we use the VIX as a timing tool for the overall market, the S&P. Any questions there, Richard?
No, but I mean, that's pretty powerful what you just said. A lot of folks that have been learning about the Slingshot, we've been teaching it now for, I guess, almost 2 years. And before that, maybe in our old mastermind coaching, we would teach it. But that was always like the question was, when was the drop going to stop? When was it time to actually enter the trade to go long to ride it back up to that Bollinger Band break? And I mean, you're just giving away like the biggest nugget that you can get in that. I mean, this is that key.
It's an incredible tool. Nothing's 100% in the market, but I've used this methodology for many years, and it's served me very well to help time these turning points in the market, whether it's on a sell-off or on a rebound. So while a lot of other people are struggling right now in the market to make sense of what's going on, you guys can use these tools that I'm sharing with you with the VIX and the S&P, and we'll look at the Nasdaq here real quick to know what's going on. This is how the institutions time these things. This is why buyers, from big institutions and funds come in and buy up at lower prices. That's what they're looking for. They're looking for a volatility crush with a basing of the S&P at a support level where there was previous buying activity. That's a golden nugget right there. So on the Nasdaq, we haven't seen the full, there's still opportunity here. We have not seen the full slingshot play out, but there is one caveat. So there was a mini slingshot on the Nasdaq. So you can see here, this is where the slingshot started, the volatility expansion. It did actually technically return back up to that level early in the sell-off. So there's a mini slingshot there. So if we want to be really precise, the second slingshot, the big one, didn't actually start till right here. And we did pretty much come back up into that level. But usually on the major indices, when you see these slingshots, you'll still end up seeing the return to that initial volatility expansion. So I still expect that we'll come back up at some point to the 15,700 level on the Nasdaq, but we just haven't done that yet. And so we could see, because we're seeing a similar pattern here on the Nasdaq as the S&P. So we could see that W pattern here where we come back down and then we form this W and double bottom, and then come back up to that initial volatility expansion level. So same thing, we really need to map out our support level. So this 14,000 level is very strong. That's where we bottomed. And we actually got two trade trend buy warnings here. So really nice, accurate buy warnings on a slingshot. So this gives us confidence to go long off this level with confluence of other price action at that level. So it was a previous resistance from back in March, April timeframe. So if you had mapped this out, you could have been well prepared for this basing at 14,000, then a rebound. So a double bottom on 14,000. If I see more rejection, assuming we sell off and see a double bottom here, then I'm a buyer around 14,000 on the Nasdaq, because I'm ultimately expecting price to get back up into the 15,700 level on the Nasdaq. So we're going to look at a way to play this. I mean, most people are not going to buy shares of the Nasdaq. It's trading at just under $15,000 a share. So most people are going to, and same with S&P, they're not going to buy shares of it. So most traders are going to play this with options. And there's a lot of ways that we can, use options to play these types of things. So I'm going to show you a real quick trick, a specific strategy. Yeah, Chris, the slingshot can definitely be used with individual stocks as well, not just the indices. You'll look, and as well as any time frame. You'll see that set up all over the place on individual equities, ETFs, because it's all market psychology. All it is there's panic selling on a volatility expansion, and then generally, because as retail traders, really none of us have the buying power or capital to drive prices back up. We're really just following the big guys. So generally institutions come in and buy on panic selling. So all the retail people are panicking as the market's crashing, while institutions are sitting there just patiently waiting for what I've taught you, the slingshot. They don't call it that. That's my term, but that's what they're doing. They're waiting for price to base. They're waiting for the VIX to come down, and they come in and buy. And that's really what causes these major rebounds, is institutional buying. Sorry, I lost my train of thought. I was going to. We were talking about how to play this calendar spread. So let me pause there before I get over it, because I don't want to leave any questions unanswered. Are there any, Richard, on that?
None so far. I think you can move on to the next part.
All right. So in terms of using options to play these types of things, there's so many different strategies that you could do a vertical call spread, which would be a debit spread. Basically, you're buying a call and selling a call, same expiration, limited risk, limited reward strategy. Some people will just buy straight calls. There's another really great strategy that can help us navigate these. So it's called a calendar spread. Now, with a calendar spread, let me just show you how it's structured. You are buying a longer dated option and then selling a shorter dated option. And so I'm going to tell you, so we'll kind of set one up and see what that looks like. And let me actually use the think back here. See, like if we had done it, I think I can do this on the platform, and we're on the demo platform, so sometimes it's limited on what it allows you to do. Let me see if I can set one of these up. So let's go back to, let's see, where's my chart? There it is. Let's look at the S&P. So like if we went back to where the S&P was bottoming here, so let's just say like January 27th. And we wanted to set up a calendar spread because, and this is a directional option strategy. So if we expect the underlying security to move up, we would do a call calendar spread. These can also be traded on bearish expectations. So if you expect the underlying security to go down, you could do a put calendar spread. But in this case, we'd be looking to do a call calendar spread. So we want to go out in expiration. Generally, on a slingshot setup, because they typically occur pretty quickly, I might go out like 2 to 3 weeks. So back on January 27th, I might go out to the February 16th expiration and look at buying an out of the money call. Now, how do I know how far out of the money to go? Well, there's a really cool feature with options, and a lot of people don't know this or use this either, that tells you an expected move over a certain period of time. So we can actually know with and it's about 70% accurate, because if you're familiar with statistics and standard deviation bell curves, a certain occurrence takes place within one standard deviation 68% of the time. So almost 70% of the time, this will play out. And that's what the implied volatility stats use. So if we look at if you use TOS, you can get it here. I'll show you another quick and dirty way to do it. But if you look at the implied move this is from back on January 27th for the February 16th expiration. So if we're getting in our DeLorean and going back to January 27th, and we see the slingshot set up, we're looking to come in as buyers. We want to use an option strategy to take advantage of up move in the S&P. And we go out 20 days in expiration, so about 3 weeks, to February 16th. Well, how do we know how far the S&P may move between January 27th and February 16th? That's what this number tells us. The market is, the options market is pricing in a 246-point move to the upside or the downside between January 27th and February 16th. And that's calculated with about a 70% probability. Now, in my experience and opinion, that percentage is much higher when we're using it with all the methodologies that we covered in our session so far with the slingshot, using the VIX and support levels. In my experience, that can be closer to 80 to 90%. So this number is given to you on each expiration in your options chain. So if you ever want to know, if you're looking at buying a stock or an ETF or whatever, or even trading options, if you ever want to know what the market is expecting in terms of a move up or down between the day you're looking to place your trade and any day in the future, just look at your options chain, turn to your options chain and look at the expiration, and you can have that information with a pretty high degree of accuracy. So how do we use that when selecting a strike price? Well, that's what I'll show you. So if we go back to that February 16th, actually, let's go ahead and use, we'll use the weeklies. February 16th expiration. So the market is implying a 246 move up or down. So we don't know whether it's up or down, but that's why we use the other analysis tools that we talked about, the VIX, the Slingshot, volatility bands, support levels. So our expectation is going to move up at least 246 points. If you don't have TOS or your options platform doesn't provide that statistic in your options chain, the quick and dirty way to do it is just take the strike price that's closest to the current price of the underlying. So on February 27th, the S&P closed at 43.26. So 43.25 would be your closest strike. So just take the put options and the call options and add those together. And you'll get a fairly close, quick and dirty way to tell what the implied move is. This one's a little bit under, so our midpoint's about 101 here, 119, so 220. So this, the at the money, and the reason it's not quite exact is because the S&P isn't at exactly 43.25, that strike price. But that's why I generally, if your platform has it, I would use that number. But it gives us a quick and dirty implied move just by adding the at the money call and put strike premium. So take the midpoint between the bid and the ask, add those together for the put and call side. And it's going to give you a pretty close estimate of the implied move between the current day's date and whatever expiration you're looking at. So how do we use that information to select a strike price? Well, if the options market is implying a move between January 27th and February 16th of 246 points, we want to pull out our handy calculator and add the current closing price, 43.26, to 246. So our potential move up is into the 45, let's call it 45.75 level. To increase my probabilities, I generally will undershoot this. So 4,500 might be a very strong resistance level. So I might, select a strike a little below 4,500. But that would be my long strike. So maybe I'll select a 44.75 strike. So that would be the option that we would be buying, the 45.75. Now, a calendar spread involves buying and selling the same strike, but at different expirations. Now, here's another thing to look for, implied volatility. Generally, the implied volatility of the further out expiration should be lower than the near-term expiration that you're going to be selling your call option. Okay, so this will become clear as I set this up. So the nice thing is we have weekly options here. So we can go out to Friday's expiration. Okay, and this is the one we're going to be selling. So 44.75. Okay, so I'm going to, and this helps finance the cost of that longer term call. Okay, so we're going to be buying a calendar spread. This is done for a debit. And that involves selling the nearer term 44.75 call and buying, we got to change the expiration here to February 16th, the longer dated call. All right, but in this case, this isn't a great calendar spread setup because the implied volatility is not much different on the near dated expiration. We generally want to see much lower implied volatility on the near term, or sorry, higher implied volatility on the near term option that we're selling, with lower implied volatility on the longer dated option. That would be the February 16th. So again, if we look at the charts, right, and we can also use the Slingshot to select strikes, but I'm just using implied move. But if we look at the chart, we did break through 4,500, but we placed our strike down here around 44.75. So we could have actually, selected a higher strike and probably done better. But you can see it. So one of these call spreads would cost you about $3,500. So, if we just did 3,500 and then, so let's see here, go back to my chart. So we want to look for, this is where we use the Slingshot with the calendar spread. We want to look for the price to come back up to that level, right? And it did on February 2nd. So we look at the calendar spread on February 2nd. So this is just, oh, that shouldn't be right. There it goes. This is just a week later. So then under a week, this calendar spread, remember it cost us $3,500, $3,590 per spread in the contract. We got almost 100% return. And that's how we know when we exit this, February 2nd, because we came up, that was the day we came up and hit that volatility expansion level in the Slingshot setup. So that's a nice 100%, close to a 100% return. You can see the profit on this calendar spread February 2nd. So just from January 27th, where we would have entered, and February 2nd, and you actually could have entered this at a lower price, but that's how we would do that. So you can see the profit potential in these. Generally, I'm looking for about a 75 to 150% return on a calendar spread like this. But that's basically how you would set those up. And they're great option strategies to use, especially on the indices with the Slingshot setup. And they can help us identify what strike to select, which expirations. Now, the other beautiful thing we're not going to get into tonight due to our limited time is these are adjustable too. So what if we got the timing wrong and the S&P didn't rebound in our allotted time frame? Well, since we're holding a longer dated option and we're selling nearer term options, we can go ahead and that if the S&P didn't get back up above 475, our strike price, we would keep the premium from the nearer dated option that we sold, and we could go out to the next week's expiration and sell another 44.75 strike call contract. So we're basically adding more income on the short position to finance this longer dated option that we bought the February 16th expiration if it doesn't work out on that very first week. In this case, it did work out in the first week. And there's a lot of other ways to adjust these, but again, we don't have time for that tonight. That's for another day. But that's the calendar spread. It's a beautiful strategy when used in the fashion that I've outlined with the Slingshot setup, support levels. And generally, even outside of the context of the Slingshot, I'll look for a security to base at a strong support level, and that can help me time really nice entries when a stock's turning around, and look for 75 to 125% returns on a calendar spread. All right, so man, I ran longer than I wanted to again, but we have about 15 minutes left, and we're actually transitioning over to our beta session after this. So our beta users who use our Zillion platform, if you guys are on with us now, if you could stay on after the hour, but we've got about 15 minutes left, and I want to use the time to do what I promised, which was allow you guys to share any symbols you guys want to take a look at. Oh, let's see if we got our refresh here. Yeah, we got our data refresh on Zillion. So if you guys want to share any symbols, please put those in the chat or the Q&A. I'd be happy to take a look at those. And in the meantime, Richard, if there are any questions.
Let's see. Derek was quick on the draw. He's at Amazon.
Okay, let me pull that up here.
Yeah, and guys, if you have questions about that strategy itself, watch the recording. And then when there are any questions that carry over, we'll just address those on the next call.
Yeah, that's why we record these guys, because I know it's a lot of information in a short time. So we do post these recordings in our members area as well as on our YouTube channel. Altos Trading is our YouTube channel. You guys can follow that as well. It's a great way to just go into YouTube and search for Altos Trading. You'll get, if you follow us on YouTube, you'll get notified when we post the recordings as well. So you can go back and review those anytime you want. Okay, Amazon, was it?
Yes.
Okay. Let's go type in Amazon.
No questions in particular, just put in Amazon. So.
Okay. Yeah, we definitely got a slingshot on Amazon. So here's the volatility expansion. We haven't quite completed the slingshot, although also with the caveat, we had a little bit of a mini one here, sell off with it. So we know that the slingshot's over when price returns back up to where it started to trail the lower band. But again, typically we'll see the full completion of the slingshot at some point. Had a pretty big move up in Amazon today. We had a buy warning with trade trend there at the end of January. Trigger here. And nice move up. This one is still an open trade with trade trend. You can see the trailing stop is now right around the 3,100 level. So this one's actually a really nice slingshot. And ultimately, I would expect price, especially if we see it break this bearish candle here, to return back up into the 33.25 level right there. So that could be a good price target for Amazon near term. But yeah, this is a beautiful slingshot. And we talked about before too, guys. You can trade the slingshots when the volatility expansion starts too. If you trade options, you can trade, and that's where I would maybe look to use a put calendar spread. You can use the put calendar spread. It's just the exact mirror opposite of what I just showed you with the call calendar spread. Sell a longer date, or you buy a longer dated put option, and then sell a nearer dated put option at the same strike price. That's a calendar spread. And you can see we got a number of sell warnings here on the way down. So this is actually a great opportunity at the downside as well. All right, what's our next one?
We got DFS.
DFS, it's our Discover Financial. Not a name that I'm follow, but in terms of analysis, I see this is definitely a tradable stock for me. I see strong support right around the 110. This really is kind of a ranging stock right now. Very strong resistance around the 130 and the 134. These ranging stocks can be great trading opportunities for calendar spreads as well. So we look to set up the call calendar spread using everything I showed you. Oops, let me redo that one. Call calendar spread when we hit the support, and then we can use put calendar spreads off the resistance. There. So this one, we had a buy warning here end of January. The trigger entry would have been around the 118, but within the first 3 candles, or the first 3 days after that one, we didn't quite come up and hit that. But some of our members do keep our trade trend pending buys open longer than the 3-day allotment that we have the algorithm program for. So that would have been a nice entry there. So yeah, I basically see potential move back up into the 130 level with strong resistance up there around 130, and then I would watch that level, and those are kind of the two the zones I would watch here is about 130. And coincidentally, those are the outer volatility bands. So 2 standard deviation moves up and down. You can see that's where this thing is rangy. 2 standard deviations from the mean. 130, see that's near the upper band, and 110. So often you'll find confluence between these outer volatility bands in static support and resistance levels. See that? They just happen to coincide. Kind of cool. That's another good one. What do we got next?
Before we look at another ticker, Amy's had a good question about calendar spreads. She's saying, can you do 2 or 3 months expiration versus a little closer? So saying like selling options, let's say in 2 weeks, but buying 2 months out, where there's any advantages to going longer?
Yeah, absolutely. So, it wasn't until like the late 90s that we had weekly options available. So it used to just be like when I first started trading options, there were no weekly options. There was only monthlies. So what I demonstrated, yeah, absolutely. I mean, you could use it if the stock doesn't have weekly options. You can use this with any security that has monthly options and go further out. Or if you just have a longer time horizon and you want to give this thing more time to play out, you could go, 3 months out on your longer dated option, the one you're buying. And it's all going to be the same. You're still going to look at the implied move between today and 3 months from now, and then go out that distance for your strike, whether you're bullish or bearish. If you're bullish, you would do a call calendar spread. If you're bearish, you do a put calendar spread, and then you would just sell the nearest dated option. So if the security only has monthly options, you would choose the near term monthly option. If it has weeklies, you can still go out that far, and then you just got that many more weeks to make adjustments to it and everything else. And depending on how much you want to pay for the spread, you may not want to sell the short option, the one that you're selling to open, at just only a week out. If you're going to 3 months out in the long option, you may want to go 2 or 3 or 4 weeks out on the short option. So you got a lot of flexibility there, and then you can kind of figure out how much you're going to pay for the spread based on because you're collecting a premium for selling the short option, and then you're spending money to buy the long option. It results in a net debit, but it basically reduces the cost of your directional play by selling that shorter dated option. And the risk is always limited to whatever you're paying for the spread. So, not factoring in any potential adjustments you might do down the road, but initially when you first put the spread on, you can't lose any more than whatever the spread cost you. That's your maximum risk.
Gotcha. Let's see, probably have time for a couple more. COST.
Costco, yep.
Yeah.
Oh, another beautiful slingshot here. Hasn't quite played out. It's close. Let's see. So yeah, somebody asked, does this work on stocks? Yeah, definitely. Actually, the price really started to trail the band on this candle. This is where it really started to touch. So I still might expect a completion of this move up into that level. But you see, we got the sell-off. We actually had a nice sell warning up here at the top from Trade Trend. Nice short trade there. Then we got a nice buy there. Look at the confluence. So we see that buy and see this support level. I mean, this is exactly what we just looked at on the S&P. It's picture perfect. Now, this is what you want to look for. Now, because this is an individual stock, it's a little more tricky to use. You can't really incorporate the VIX quite as easily. You still can, because a lot of stocks trade with the broader indices, right? So especially a stock like Costco or Amazon or some of these bigger names we looked at, they're generally going to trade. They're often what's driving these indices. Like the FANG stocks, are really going to be the bulk of the market cap of the Nasdaq 100, right? So always pay attention to what stock you're trading and how it's impacted by whatever index it trades in. So the VIX still, can obviously be used. It just doesn't apply specifically to that stock. But this is another picture perfect slingshot. So we get our horizontal support. We get our buy warning. We get a trigger here. And then we get our rebounds to see what kind of great opportunities this can provide for us. Really nice. And another great opportunity to, Costco, I believe, has weekly options on it. This would have been a great opportunity to trade a call calendar spread. And again, just, when we get this pending buy here, we go into our options chain for Costco. And that would have been back on January 24th. We look at the implied move on that day, and we go out roughly that amount, but we also want to look at our slingshot and see where the return level is, and select a strike, buy that out of the money call, sell a near term call at the same strike to help finance the purchase of that call. And, this probably could have been a double bagger. We probably could have hit 100% ROI on this type of a call calendar spread on this slingshot. Another really good one. All right, so we just got about 4 minutes left. We have to transition over into our final beta session for our Zillion users. We are doing a full launch of our Zillion dashboard here towards the end of February. So we're really excited about that. So we're wrapping up our live beta session tonight. So again, if any beta users for Zillion are on tonight, please stay on with us as we transition over. But let's go ahead and wrap up with Q&A and see if there are any questions before we sign off from our live session.
Yeah, it looks like there's nothing really pending in there. Only thing that came up is, do you ever really look at volume whenever you're looking at SPX or any of the major indices?
It's just not a major, ideally you want to see when you get a rebound or a move up, you want to see it on strong volume. But it's not as reliable as the other things I've shared with you. I mean, you will see, these types of turnarounds on average volume, so if you don't want to use it as a standalone tool, but it's just more confluence if it lines up with, these rebounds off a support level or on the slingshot. If you see buy volume start to pick up, then that can just kind of be added confirmation. So I do look at volume, but it's more of not even a secondary or even tertiary, indicator for me, but something that, I might take a look at.
That's all I got.
Awesome. Well, thanks so much, guys. Again, we're just a few weeks away from our full Zillion launch. So we do still have early bird pricing available. So if you want to get access to our Zillion platform at a 50% discount with the full suite of features, then you can go ahead and do that. But you've only got a couple of weeks to do that. And then we're going to full launch and full pricing for Zillion. So now's kind of your window of opportunity to get in at a 50% discount. It's only $49 a month, and you get the Zillion dashboard and all the tools that come along with it. All the scanners, all the statistical tools. You get 3 different modes, and we're going to be talking more about this. Anyone that wants to stay on for the beta session is welcome to, if you want to learn a little bit more about Zillion and what we're doing. But you get 3 different modes for trade trend. You get divergence cloud, all these really great things. You get statistics to run stats and all the signals and different trade ideas and everything. So anyway, that's still available. Just zilliontree.com is the website if you guys want to get in on the early bird special before it goes to full pricing. But thanks again, everybody, for joining. It's a pleasure to have everybody on. I hope you got a lot out of the session. We'll go ahead and pause here as we transition over into our beta session.